Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Firms That Win in 2025. What advisors are really looking for. It's a special industry update with Mindy Diamond. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
With so many firms competing for top talent, the question isn't whether advisors have options, it's how they choose and why. That is, it's really about what separates a good firm from the one that actually wins the talent. Because the reality is that advisor expectations have changed. What used to be considered best in class is now often table stakes. Today's winners are offering clarity, consistency, flexibility, and a value proposition that meets advisors where they are. In this special industry update, I sit down with Mindy Diamond to share our current view of the market, what advisors are telling us they value most, what's become commoditized, and which firms are truly winning the attention and trust of top talent. We also talk through why more firms are starting to look and feel the same, what's changed in advisor expectations over the last decade, the deal breakers we see after a transition, why some firms excel in one area but fall short in others, and what the ideal firm of the future might look like if you built it from scratch. Whether you're simply curious how the landscape is shifting, considering a move, or leading a firm, this episode is designed to give you a clear and candid snapshot of what's working, what's not, and what might be coming next. So let's dive in. Mindy, thank you for joining us.
Oh, I'm so happy to be here, and I love this topic, so thank you for having me.
It's a fun one. I'll ask the first question of you, and then we can bat it around from there. How would you describe the state of the wealth management firm landscape in 2025?
Robust, vast, fun, exciting, sophisticated, creative, etc., etc., etc. I think that I'm at this 30 years, and in 30 years, it was beyond expectation or my wildest dreams how the industry landscape has expanded and really stepped up. The landscape has grown to really meet the needs and the desires of what top advisors want. It's such an exciting time to be an advisor, and there's no holds barred. If an advisor wants to be an employee, lots of choices. An advisor wants to be independent, even more choices. Advisors want something in between, even more choices. And that's what makes it such a great time to be an advisor. So let me ask you, are we seeing more differentiation or is it more sameness across the board?
Yeah, I think it's a little bit of both. The number of firms I speak to or who reach out to us presenting something that they view as different, but it's really just commoditized, or it seems like there's a lot of the same going around, but there's certainly elements of new and emerging firms, or certainly firms have unique elements that make them different in totality. So I look at it, part cynically and part just trying to be fair and objective. I think there's a lot of sameness that some folks view as differentiation, but it's really just the same thing repackaged. But there is truly more differentiated options than ever before for advisors, similar to your point earlier.
So when you see sameness, like what kind of things you mean are the same and what kind of things are different?
Yeah, a couple of examples. The number of firms now who say they provide a supported version of independence for advisors has skyrocketed. But when you really look under the hood, they're providing compliance and technology and billing, and there's not a whole lot else. So some of it might just be in positioning or marketing. I think what really separates the best firms from the rest is what are the actual tangible points of differentiation that truly are different from other firms. Like, we have a great culture, our people are really experienced, our advisors are happy. Like, that's not an element of differentiation. So maybe part of it is just how people articulate what their differences are and recognizing and just being honest about what actually are the things that everyone does versus what makes a firm world class.
Yeah, and I think maybe a way to think about it is sameness is not a bad thing because sameness really represents what advisors want. They want a notion of using the example of supported independence, or they want a firm, a big firm that scaffolds them and they want great technology. So it's not that every new firm that comes on the scene needs to reinvent itself completely. It's about responding to what advisors want and picking up, bettering what could have been better. I think that's a fair way to say it.
I think that's a great point. And you're right. In this industry, like, there's only so much innovation that one firm can offer. 'Cause at the end of the day, where advisors are providing a certain service to clients, it's a highly regulated industry. So I think elements of sameness are expected, and honestly, it's welcomed because it's familiar. And many firms do things really well. So it's okay to be same in some areas, but you do have to figure out what your point of differentiation is. So
Yeah,
I think
and
it's a great way to put it.
maybe it's like iterating at the margins,
That's right.
right? It's maintaining stability around the things that are really important, that are table stakes, if you will, and then iterating around the margins when a new firm comes on board and makes better something that some other firm might have gotten wrong or what was missing in the landscape.
What do you see has changed the most in terms of what advisors value when evaluating firms?
To me, that's the biggest change. Yes, the industry landscape has expanded. And yes, there are more very legitimate options than ever before. And that's exciting. But the thing I think we talk about most, certainly with top advisors, is what drives them. So when I started the business 30 years ago, it was all about how much upfront money are they offering? What's the deal? Was what they would say.
That's right.
And to give you some perspective, in those days, 100% deal, meaning a firm offering 100% of trailing 12 months production for $1 million advisor was huge. And people would sometimes, when they'd want to blow me off the phone, they'd say, call me when deals get to 100%. That should give you some perspective. So deals are now probably 4 times that. So yes, that's changed. But I think the biggest thing that's changed, and we talk about this a lot, is advisor mindset, the notion of what advisors value most. And that falls into 2 categories. The first is about wanting freedom, flexibility, and control. They want to live and breathe in an environment where they feel they have agency over how they can service clients and what they're able to do to grow the business. They want less bureaucracy. But the second thing is, even when an advisor is perfectly happy, we sometimes see advisors moving. Why? Yeah, some might be cynical and say because they want to get a deal up front, but that's not really it. Because many of those advisors that are moving aren't moving for a big check up front. They're betting on the long term. And what they're most interested in is building or maximizing enterprise value. So maybe you can pick up there. What do we mean by that when we say maximizing enterprise value, and how do advisors think about that?
Yeah, first off, I think those are both amazing points. And to encapsulate, I think the spirit of what you said was advisors have shifted from just valuing the deal and valuing the short-term economics essentially for many other things. And I think maximizing their long-term value is a great example. Of course, there's an economic component of it, but it's thinking about the value over the long term because enterprise value is defined as the summation of future expected cash flows. So it's thinking about where am I going to get paid the most on a net basis? So that could be I get a higher payout if I'm independent. It could mean where can I go where I can actually sell the business in the future for the greatest amount. Where can I grow the fastest? Where can I take the most amount of chips off the table today? Everything's connected. So even just looking at the economic side, it shifted from valuing the short term and the certainty to now valuing short term, medium term, but also most importantly, the long term and how someone can maximize the terminal value of the business when they look to sell or exit the business.
Well said. And I think that's what's changed the most. It's not that an advisor 30 years ago didn't value what the business was going to be worth at the end of the day, but there was no real way for them to monetize it unless they went independent and were sort of an outlier. The valuations, even for an independent business, were not anywhere near what they are today. And in those days, there were no retire in place programs in the traditional firms. So all an advisor could do was control what he did today. So either choose to stay put and grow the business one advisor at a time, or perhaps move once and monetize twice, meaning jump to a new firm, monetize the business, and maybe move again. So that's the other piece. There's so many more options today in terms of how an advisor can really think about not only maximizing the value in the short term, but as you said, the medium term and the long term. Okay, so let me ask you a question. With that backdrop in mind, the notion that it's about wanting more agency over the business and the notion of wanting to really maximize the value of the business at day's end, how then, if they're going to evaluate a firm, if they're looking at options, what are the things that they need to look at the most? Is it the brand of the firm? Is it technology? Is it the advisor ratio to support staff? What is it exactly?
Yeah, I think it's that and more. So while we talked about the shift in what advisors value, there's still a number of non-negotiables that advisors really care about. That is, I'd say some of them are more short-term oriented. It's just the elements that advisors really prioritize when viewing a firm. So you hit on brand strength. That's especially for a wirehouse advisor. That's always pretty important. How are my clients going to feel leaving Merrill or UBS or Morgan Stanley and going to either a lesser known brand like a RBC or a Raymond James or my own brand? A lot of advisors view it as their brand is themselves. It's their team, and they're very comfortable starting an RIA with Schwab as custodian. Others are very focused on the cachet and may value a Rockefeller, a private wealth segment at Morgan Stanley, et cetera. So brand in general doesn't even have to be strength, but just brand I think is an important one. I'd say culture is another big one, pretty challenging to define a firm's culture, but you know it when you see it. And we call them the regional firms, the Ray J's and Stiefels and RBCs of the world. They really tout their culture as being different. And you really can't understand it unless you really engage with the firms and really take it in. That's more though, trusting your gut and going with which culture feels the best to you. We talked about economics, certainly the upfront deal. Is there equity? What's the payout? Is there deferred compensation? Are there bonuses? What's the retirement path look like, et cetera? Technology is huge. Many of the firms that advisors come from have very good tech stacks. They're integrated, they work well. Others might not be as much. But at the end of the day, technology is what's driving any business. It's how advisors find efficiency. So looking at tech stacks and making sure that at a minimum it works well enough, but also that the tech stack ideally is going to be better than where someone's coming from. Flexibility is a huge one. Can I have outside business activities? Can I migrate to independence in the future? Can I have my own brand? Can I market myself the way I want to? If I have an issue, can I raise it and get an exception? Is my branch manager going to help me navigate issues? All very critical. And then I'll give one more, and then there's probably gaps that I missed, but I'd say long-term growth support. So this could mean consulting with how to segment clients or develop a marketing or go-to-market strategy. It could mean recruiting advisors into my practice. It could mean acquiring businesses through retiring advisor programs or traditional M&A. It could mean where am I going to have the least amount of constraints in my business so I can grow it faster. So there's a number of other things and a lot of fringe cases that we see, but did I miss anything?
I don't think you miss anything at all. I think well said. And what it comes down to is everyone needs to assess both the status quo, meaning current firm, current ability to serve the today, the tomorrow, and the end of the day ability to maximize the business, against any other firm and really do the same thing. So when you take something amorphous like culture, what we mean by that is assessing, looking at a new firm and saying, how does its culture around compliance, around oversight, around bureaucracy, around who owns the client, around investing in client, around adding technology, whatever it may be, how will that ultimately impact my today, my tomorrow, and the end of the day? That's really what it comes down to. So let's drill down a little or get a little specific. What firms are winning? And we've always said historically that there's no one winner, that the winners are somewhat fractured depending upon what an advisor wants. And while that is still true, there are certainly firms that are winning more often than others. So I'd love for you to talk a little bit about who's winning, why they're winning, and what they're doing to really stand out from the pack.
Yeah, I think it's a great question. I think part of the answer of who's winning is that there isn't one firm or one type of firm that is the outright winner. There's a lot of winners, which is, I think, amazing because it means advisors have more choices than before, and firms who are starting off or are trying to stay in business have a number of different ways that they can win. Like you don't have to win all however many thousands of advisors who move in a given year to be successful. So I would look at it in the different buckets or categories in the industry. And I don't mean to hurt anyone's feelings or leave anyone out, but I'd say in the wirehouse world, Morgan Stanley seems to have really been the outright winner in the wirehouse world. And some of the differentiators that advisors would point to there are that they're a wealth manager that owns a bank rather than a bank that owns a wealth management firm. Sounds like a nuance, but it's important in how they service advisors and how important wealth management is to the overall whole. I'd say also brand and technology are big differentiators. But at the same time, many advisors are not going to be interested in going wirehouse to wirehouse, which leaves other potential channels or avenues. So in the regional or the super regional space, I'd point to Raymond James and RBC right now as winning. Both of them offer more flexibility and autonomy. I talked about culture, that would be a differentiator. They don't change compensation. Branch managers have the ability to actually influence things. If there's a problem, you can get exceptions. In the case of Raymond James, you can go independent in the future. So those would be some differentiators for those firms. And then I'd say point to like a Rockefeller as being one of the more interesting firms right now. They're not going to be an outright winner as far as percent of advisors hired because they're a smaller firm. They're not looking to hire hundreds and hundreds of advisors. To them, winning a couple of mega teams a year is probably good enough. And what stands out for them as an example is brand. It's the resources. It's what they can do on the ultra high net worth side with family office services, with private investments. And then one other big winner I'd say right now would be LPL Financial. And they would split across multiple channels. They have a W-2 model, a traditional independent broker-dealer model. They can be a custodian. They can be a supportive version of independence. But I think that's what makes them different, is that they have all these different options under one roof, like similar to Raymond James or to Ameriprise has two channels. Wells Fargo has multiple. Those would be a couple of the winners I'm seeing right now and some of the main differentiators that advisors are pointing to.
I think that's really right. Like if we were going to summarize it and pick one firm from each category across the landscape, I think that you're absolutely right. But let me ask you a couple questions. I want to connect the dots for our listeners. So if someone values more than anything, building long-term enterprise value, building a business that they can sell at the end of the day, which of those models is the best?
I would probably say it would be an LPO model or a number of RIA custodians, supportive versions of independence that we didn't mention. Because ultimately, at least for now, the valuations on an independent business far surpass any deal structure that's available for an advisor transition. And typically, those deals can be at long-term capital gains. I would say it would be something in the independent world, but it doesn't mean that if you go from wirehouse to wirehouse or you go from UBS to RBC, that you're selling yourself short. There's also the option of retiring through these firms' retire in place programs or making a transition now and then 10, 12, 15 years from now, assessing the landscape again. And maybe then you take the business independent or you recapitalize again through another move.
let's talk about a firm like Rockefeller. And there's a lot of firms in that category. So not a lot of firms have the cachet of the name Rockefeller, but there are other firms, other boutique firms that sort of fall into the same category with similar value propositions. So what if an advisor that doesn't want to be independent, but still really values the long term, wants to build real value? What options should he or she consider there?
Yeah, honestly, I think there's like a ton of firms across the spectrum could fit. It probably comes more down to what an advisor's goals are. And do they actually want to be a business owner, or do they just want to be an advisor? Because there's options now that kind of be a cross between an RIA and a boutique firm of joining or merging your practice with an existing RIA firm, one where you can get equity in them, where they provide all the infrastructure, but you're left alone to do your thing. And you can build immense value through the equity appreciation in these firms on top of any upfront money they gave you or an earnout and the ongoing payout. So that's, I think, a good example that it's hard to pick and choose because some advisors would value controlling their own destiny, owning the equity in their business, which would mean some version of independent. It could mean Raymond James as a firm where advisors own their books of business. It can even be, let's go to Morgan Stanley, because at the end of the day, it's my relationships. Even if legally the firm owns the relationships, I know that my value is tied up in the goodwill I've created with my clients. And if I ever wanted to transition or sell, I'd be able to because I have a lot of confidence in what I've built.
Yeah, and I think we would both agree that if someone values truly maximizing, getting top dollar for the business they've built, then the only way to do that is to be independent and sell the business on the open market. And today's valuations are sky high. But here's the truth, and I think you'd agree with this. 99% of the advisors we talk with, while who wouldn't want to maximize the value of the business they've built, most of them are okay if they leave some chips on the table, because where they want to live is some intersection between quality of life, feeling good about the way they're living their business life, their ability to grow, their ability to serve clients the way they want to, and the ability to monetize the business at day's end. So even if it means they take a 10% haircut on what the business could be worth at the end of the day, one model versus another, most advisors would be more than okay with it. And so would I. Do you agree with that?
Completely agree. It's hard to just sit here with a Excel spreadsheet and make a broad assumption because a financial model is garbage in, garbage out. And it's all based upon a number of factors that are outside of anyone's control. So to me, I agree with you. How fulfilled are you? Are you excited about going to work? Can you do the best work for clients? That might drive growth. And that might be the most important thing to an advisor, where someone else is just going to look at the dollars and cents and say, if I grow at 10% per year and I look to sell the business or retire in 10 years, where am I going to get the most amount of money? I think in many cases, it's making the wrong assumptions because there's so many different ways to be successful. And there's so many different ways to maximize your career enterprise value.
So is the ideal firm, is it a boutique? Is it a wirehouse? Is it a regional? Is it a quasi-independent? Is it an independent broker-dealer? Is it an RIA? What would you say to that?
Yes.
Yes. High five. I would agree with you 100%. It all depends what the advisor wants. One man's trash is another man's treasure. We talk to advisors all the time that think a wirehouse is the only way to practice, wouldn't go anywhere else. And then there are advisors that wouldn't be anything other than independent, and a million of them that practice somewhere in between. And so going back to what we said at the beginning of the episode, that's what's so exciting about the industry landscape, is that advisor choice drives it all.
Exactly right. Let me ask you a question, and I'll give my answer though, but I want to hear yours first. If we picked out the best attributes of different firms, what would those be? So as an example, who has the strongest technology? Who helps advisors grow the most? Who has the best culture? Who has the best deal? Who has the best brand? And I think the key to this answer, and not to put words in your mouth, is there isn't a firm that does everything the best, because otherwise we wouldn't be in business and that firm would have 300,000 plus financial advisors. So, but I do think there are some standouts in different categories. And then typically it comes down to advisors stack ranking and prioritizing what's most important to them. And then that may drive part of their decision making. But just to give our listeners and viewers some color, what would you say are the best attributes of some different firms?
Yeah. So, first of all, asking me and asking each firm, you'd probably get a very different answer. Because if I said to the person tasked with recruiting at UBS or Merrill Lynch, and I asked the same question of the head of recruiting for LPL or Raymond James, they would all tell me that they are 10 or the best in each of those categories. And to some degree, it's not that they're lying, it's just you could make a case for all of that. So it depends upon what the advisor wants. The Morgan Stanleys, UBS's, Merrill Lynch's, Wells Fargo's of the world would tell you they've got the best technology. They've got scale, they've got the ability to invest and to iterate, they believe, in a way that others can't. But if you ask the same question about who's got best technology in the independent, anybody in the independent space, they would talk about the notion of cutting edge, of not being limited to legacy chassis, of being able to really access third-party world-class technology. When it comes to growth, the big firms would say people grow because of our brand. People in the boutique space, the Rockefellers would say they grow because of our brand. The people in the independent space, they grow because there is no brand. They grow because they are able to really be a buy-side advocate for the client. Who's got the best deal? So I'll tell you a story that will probably illustrate that answer the best. Raymond James, on the employee side, has always been a firm that never wanted to be the top deal on the street. In fact, they pride themselves on being amongst the lowest historically and still having a lot of recruiting success. So why would people go? Well, because Raymond James does a lot of other things really well. And if you ask a Raymond James model about their deal, they're never going to tell you that their deal is really low. They're going to make you look at a spreadsheet over a span of 5 years. And when you take into account state longevity bonuses and better payout and retirement programs, that over time, the advisor actually does better. So the truth of the matter is, from where I sit, the answer to every one of those questions comes down to what the advisor values most.
I completely agree. And even taking, not to pick on or highlight one firm, but you take Raymond James as an example. If you talk to a multi-million-dollar advisor in the Southeast, they may say the Raymond James brand's great. Like, they sponsor the Tampa Bay Bucks Stadium. All my clients know who they are. They're never in the news for the wrong reasons. They didn't take TARP money, et cetera. But if you talk to a ultra high net worth focused advisor in San Francisco, they very well may say, I've heard of them, but my clients aren't really going to know who they are, or it doesn't resonate with the types of relationships that I serve. So that's a great example of the fact that we could have our opinion, but at the end of the day, we're not the ones who choose the firms for advisors. I think every advisor would have a different lens that they're evaluating things. Same thing with technology. Like, there's plenty of advisors who are coming from UBS that traditionally doesn't have the best reputation for technology, but they look at Morgan Stanley and say, this tech is so well integrated. I like that I don't have to pick all the different components. Everything just works. It talks to each other. And then someone else coming from UBS may say, I love the way that Dynasty does technology. They're our consultant to help us build our best tech stack. They work with 3 or 4 different performance reporting vendors. They'll help us integrate it. They'll help us select it. We can pick our own CRM, our own planning software. And if we use this model, we're not going to be beholden to 2 different changes that happen. We can integrate AI. We can change platforms without consequence. So I don't mean to be vague or to dodge the question. It is, and we created this question, so it's on us, but it's a bit of an unfair question because it all matters on what the advisor is leaving and kind of their sensibilities, their goals, et cetera. And that's why, again, there isn't one firm that's best. It's just advisors will evaluate things in their own way. And our job is just to enable them to make the best possible decision based upon their goals and their criteria.
Yeah. And it goes back to, again, with more choice, an advisor today is more likely to find their version of utopia. Because the next question, as you were talking, I was thinking about was the notion that, so what are the reasons why then do people leave a firm that they were once really excited to join?
It's a great question. Look, every advisor expects and hopes that the firm that they choose is their forever home. There's some advisors who are cynical and are like, hey, I joined Merrill 15 years ago. I thought it was the best place ever and it changed. Others who say, hey, it's a 10-year deal. I'll work it off and then I'll do something different. But for the most part, similar to buying a house, you don't think you're ever going to move, right? I got 5 bedrooms. My family's big. My family is they only have 2 kids. It's perfectly big enough, but things change over time. But I would say like some of the big reasons that advisors leave a firm that they were once so excited about, enthusiastic about, it could be a change in compensation structures. Like if you look at some of the wirehouse compensation plan changes, basically an advisor knows today what they know now. They can't predict the future. So a big change to compensation where junior team members are penalized or they get rid of the bonus for aggregating production. That can certainly change things. There could be a change in management. So it goes from a senior leadership team who they were advisors. They understood what it was like to be an advisor, and it transitions to someone who's a banker or who is a management consultant or who doesn't really understand what's on the mind of advisors. And then the policies and their agendas kind of change things. It could be poor service where like this firm was amazing. We had a 2-to-1 home office support to advisor ratio. They picked up the phone in the first ring to expense cuts. And all of a sudden, key service people are eliminated or they go on to different opportunities and then service begins to suffer. There's a ton of things, but I think the key is advisors make decisions based upon the best of the information they have now, but things can change on a dime. And there's many things that we don't even foresee today that can push an advisor to leave a firm that they once felt so strongly about.
Yes, there's the whole category of things that firms do to change and make an advisor outgrow them. In many cases, it's not that the firm has changed so much, it's that the advisor's changed. The advisor, when they joined a firm, maybe were serving clients in the $1 to $3 million range, and over time decided they want to focus more on ultra high net worth. So they want a firm that's going to better allow them to do that. Maybe the advisor moved geographically and want to be closer to home office or something of the sort. It could be that as the advisor ages, initially the deal up front was most important, and over time it became more about the retire in place program. So it's as much about how firms change as it is about how advisors change over time.
Completely agree.
That's as it should be. And here's the thing. I remember saying 30 years ago to advisors, we believe, and it's true, that smart advisors make at least one well-timed move in their career. And I don't say that because I'm a recruiter and I get paid when somebody moves, and the truth is there are plenty of advisors that never move. But it's that question or the answer to that question that typically drives movement, because it's unrealistic to think that what served me incredibly well 25 years ago still serves me well as I've evolved, my business evolved, my family evolved, my team evolved, my clients evolved, et cetera.
And the industry has evolved too.
Right.
I think it's pretty important. Let me answer this question. This is a fun one. I think we should both answer this, but you can go first. If you and I could jointly build a firm in a lab today to attract advisors based upon everything we know about value propositions, advisor sentiment, and what really motivates advisors to make a change and what are deal breakers, et cetera, what would it include? But what would be some of the attributes that you would pick? And I'll go second.
First of all, I think I would just make the comment in general that it's pretty astounding to me that all the leader of any firm has to do is read an article or listen to a podcast, this or otherwise, to get tuned in to what matters most to advisors. And yet most firms don't do those things. Like, to me, it just seems so simple that there's so many simple things they could do to impact retention. And those simple things are things like allowing advisors to feel more ownership and agency, giving advisors the ability to tap into less bureaucracy, not changing compensation as often. And I know that's probably a naive statement because a lot of that has to do with economics. But, we talk to advisors sometimes. I had an advisor not that long ago that said that All he wanted was his firm to allow him to buy some filing cabinets for his office on their dime. And they said no. And that's probably a simplistic reason. And that's more of the straw that broke the camel's back for him. There were a lot of reasons he was looking to leave. But a lot of times it comes down to things that are that simple. If you know an advisor values freedom, flexibility, control, agency, and ultimately wants to maximize the value of the business built, then to me, a firm would be wise to build itself. And look, it might be hard for the Morgans and UBSs and Merrills. They're titanics and behemoths, and it's hard to turn in port. But as advisors who are listening, who are thinking about being independent and building a firm, or leaders of independent firms that have more nimbleness at their fingertips, hear these words. Build a firm with the end in mind. Build a firm around what's important to advisors.
Yeah, I would agree. A couple of things that come to mind. Again, mine saying all of these things are feasible or realistic. They're just elements that I know advisors value. And if I had unlimited capital and unlimited time and suspended disbelief, I would build a firm that had multiple channels where advisors, regardless of their affiliation, own their book of business, similar to the Ray J's and LPLs. That you have the W-2 model, you have various independent models, so that as an advisor's practice migrates and grows and changes, that they can stay with one firm from cradle to grave. I would build a firm that had an impressive brand. Easier said than done. But again, I said this is suspending disbelief. But if you look at like what a Rockefeller did, they weren't even around in their current form 10 years ago, but they saw an opportunity to, in essence, license or buy the Rockefeller brand. And it's been extremely powerful. But I see brand being an important driver of movement. I would say equity. So aside from equity in your own practice, getting equity in the holding company or the parent company, I see that being a really compelling way to align interests and give advisors a true sense of ownership and also ability to monetize in a different way. And then I think the last one I would say for now is a really meaningful and demonstrated growth engine. So of course, every advisor, it's incumbent upon them to grow, to ask for referrals, to get referrals from existing clients, to network at the golf club, et cetera. But I'm seeing some firms, especially more on the independent side, that have lead generation engines, whether it's referrals from RIA custodians, or it's a massive network of CPA firms that refer them business, or it's a feeder of businesses to acquire. So if I had to build a company from scratch, those would be the elements I would have. And of course, a 400% plus recruiting deal and very high payouts. But again, we're saying this kind of tongue in cheek, like this doesn't exist, which means that advisors will have to either compromise in some ways or just pick and choose what's truly most important to them and make peace with the fact that nothing's perfect.
The first one you said was you'd offer a firm that was multi-channel. And what you mean by that is a firm like a Wells Fargo or a Raymond James and several others that allow the advisor from cradle to grave to start out as an employee and eventually migrate into whatever version of independence they want. So why doesn't every firm do that? Like, to me, that's a simple one. It's a model that works and advisor wants. So what is the reason why the majority of the firms in the industry don't do that?
Yeah, I think it's probably a fear that the strategy is going to work too well, where I think everyone would agree that a multi-channel approach is going to be a benefit for recruiting, right? Because you can overcome the objection of, well, I may want to go independent, or after my dad retires 15 years from now, I'll probably want to do something different. I think the challenge is, you look at Wells Fargo as an example, they've had a ton of their top private client group, W-2, basically wirehouse advisors, migrate to Wells Fargo Finet, their independent channel. So I don't know the economics of it, but I would imagine that Wells Fargo now is going to make less money on the Finet channel than they would if someone was in a wirehouse. I think there's fear that it's just going to work too well. Like you mentioned, like these are big firms and they're steering a Titanic. It's hard to build this when today you know what your profit margin is, you know what your revenue is, and not really knowing what the future is going to hold and cannibalizing a core business. But I think it's smart. I think firms like Wells Fargo are doing it right. They're saying, hey, we stand to lose these advisors if we don't meet them where they are, and we can use it as a recruiting tool, and we'll have happier advisors as a result. But I think it's hard to make peace with the fact that you may be making a lot less money in the future. It's the same thing happening with Goldman Sachs now. Like, they have some of the industry's top advisors in their private wealth segment Like probably 95% of them have the scale to go and be independent. And they're building RIA custody now from the ground up. And I'm sure that's a very compelling proposition to their current private wealth advisors. But at least for now, they're restricting that movement because they don't want to cannibalize that part of the business. But in the end, they may be smart because most of their advisors will probably stay because it's hard to leave Goldman, but they probably will lose some big teams to independence or otherwise because advisors just have an itch that can't be scratched where they are. Let's do one or two more questions. The next one I'll ask of you. Has the bar been raised for what a firm needs to deliver to both attract advisors, but also retain them?
Yeah, without equivocation. And that's a great thing. It may not be such a great thing for a firm, but it's a great thing for advisors. It is the very fact that there is more competition than ever before for top advisors, and that in general, even if an advisor works for the most restrictive firm with the most restrictive employee post-employment restrictions, in the end, it's the advisor that really controls his clients and whether or not those clients stay. And so the firms know it. The advisors can vote with their feet and often do. And firms rather, have absolutely a responsibility to meet advisors where they are, to meet the moment, or run the risk of losing them. And so that absolutely has everything to do with investing in technology, in offering a growth engine, in finding a way to offer advisors more support, in allowing advisors to have more autonomy over what they're doing, to slide like a Wells Fargo or Raymond James from an employee channel to an independent channel. And even in the most independent of firms, the fact that advisors have choice just means that the firms need to step up and meet them where they are. And that you mentioned the word equity. That is something that is very meaningful and valuable to advisors. So maybe you can answer that question in terms of what are firms that are looking to do that, to offer more to advisors? What are they doing in terms of offering equity, and why is that meaningful to an advisor?
Yeah, man, it's a good example of what firms have to do now to attract and retain top talent. But yeah, equity is important because it can either be a real differentiator. If you look at what a RIA or a boutique firm has the ability to offer versus what a major brokerage firm can't, it's oftentimes equity. And not just, oh, we're publicly traded, so you can go on your Fidelity account and buy shares of the stock. But typically it means equity in a privately held illiquid business. That's typically equity that is harder to access or acquire and typically has more upside or room to run. So a lot of firms are smart and they're offering equity to key employees, even beyond advisors, because there's either a vesting period or someone doesn't want to leave and have to have a little bit of FOMO and miss out on what's to come. We're also seeing some new firms like And Partners or Indivisible Partners, Stored Partners, and a number of others where equity is the main currency in their deals. And they may not have to offer as much cash in a deal as someone else because equity is a major part of it. We see it all the time with RIAs too, regardless of the size, especially the ones that are private equity owned. Equity is a major part of either their acquisition structure or if they're recruiting advisors, offering an equity grant up front or a path to equity is a differentiator, but it'll also keep advisors in their seats and key people.
And how is it not a lottery ticket? Meaning, as you said, it is illiquid currency at this point. And how or why would an advisor who's got a valuable business be willing to trade upfront cash for equity, which is really a question mark?
It's certainly a question mark, but also I would make the case that getting a 400% deal and then investing it all in the S&P 500 or investing it into an individual stock is a bit of a lottery ticket too. It's just a different form of currency in a different way an advisor can take a risk. In this industry, what we've seen is there's certainly some examples, I won't name the firms, where the equity has been diluted or the projections don't come to be or the valuation that the equity is being offered at was way inflated and then the advisor's underwater. But for the most part, equity in well-run businesses, if you back the right horse in this industry, is an incredible trade. I had a client who sold their business part cash and part stock to a major RIA firm. and the equity after 3 years was worth almost 2 times what the cash component of the deal was. So all you need are a couple of examples like that to make equity really appealing. Look, it is, to me, it's a lottery ticket on who's going to 3x or 4x or 5x the value of the equity. But I think at a minimum, like at least seeing some growth in the equity, even in a conservative manner, is reasonable. And it's the long tail, the fringe case where the equity was truly a bad trade.
And it goes back to what we've been saying. If you surveyed 10 advisors, 5 of them would say it's a lottery ticket, no way, no how, not interested in the risk. And the other 5 would say, bring it on. I love the idea of the arbitrage. I'm excited about it. It's exciting and creative, and bring it on. Let me ask you one last question. So what are still some gaps in the industry, and who might be best positioned to fill it?
Yeah, great question. To me, I think one gap right now is a boutique firm, whether it's an RIA or it's a RIA built on a broker dealer that has a really strong upfront recruiting deal, offers a considerable amount of equity or the option for an advisor to choose their own adventure. So to choose the mix of cash and stock, but also has a payout that's similar or better to what a wirehouse offers. I've seen components of this, but I haven't seen a firm that truly offers a great deal up front to de-risk a move for someone, some equity in the business, and a payout that's 50, 55% or higher. I think a bonus answer would be a real demonstrated growth engine. Every advisor, not every, but 95% of advisors who make a transition, they're looking to either grow, continue growing, or love to grow faster. So it surprises me that firms don't spend more time really investing their capital in how do we drive organic growth. That's ultimately how the businesses are going to be worth more. That's what advisors want. So to me, it fills a dual mandate of we're maximizing the value of our business. This is from the firm perspective, and it's what advisors want. So it's a win-win. So to me, those are some of the potential gaps. I think some of these large private equity owned RIAs are probably the best position to fill the gap, but it's still a math equation. And those firms don't make money the same way as brokerage firms do. So I don't know how you solve for it, but going to what makes the best firm, the most ideal firm, I think if a firm was able to offer some of the things I said on the financial side and on the growth side and had a model that was unconflicted and open architecture, that would be a winning hand. So I've seen elements of it, but I think there's room for someone to really figure it out.
I think that they will. I think that's the point. The exciting thing about how this whole world of wealth management has evolved is that we're only limited by people's imaginations or people's desire to build it. We've proven that advisors are entrepreneurial. We've proven that advisors will move if the right model exists, the right confluence of economics and value proposition and solving for what's important to the advisor. So my bet is that will be built. And my hope, as I'm thinking to myself as you're saying that, is I hope that the person who's going to build that firm is listening to this episode, and no one's better positioned than we are to be able to talk about in general what drives advisor movement or what's on the mind of advisors. And that's really the key, is building a firm that advisors want to work for.
And many of the best businesses we've seen created were because an advisor or a prior manager or firm leader says, I looked around, I didn't really want to start my own business, but I felt compelled to because there wasn't anything that met my needs. And I can translate that to, if my needs aren't being met, there must be others that feel the same way. That's the calling card for Crescent, Stewart Partners, Sanctuary, Dynasty. You fill in the blank. My guess is for pretty much every new and fast growing firm that's out there. I'm sure Greg Fleming said it when he started Rockefeller. That's the spark, is I don't really want to start my own business because it's a big pain in the butt. But with all of me, I need to build this because I know what I want, what I need, what my clients need, and it doesn't exist. Go do it. And let's go find people that feel the same way.
Well said.
Mindy, thank you for joining us and sharing some of your 30 plus years of wisdom. I think there's so much to this topic. There's so many firms, so much to talk about, so much to like about a lot of different firms and types of firms. And advisors are in the catbird seat to pick and choose what's most important to them. My guess is there's something that's out there for everyone. And again, if it's not there, it's a call to action to go build it on your own. No one would be a bigger supporter than us. So we'll wrap here. I will say that we have a pretty exciting update to our annual transitions report that's upcoming with some updated data. And we'll do a more focused or zoomed in version of reports highlighting Merrill, UBS, and Edward Jones, both movement to and from those firms. So watch for the episode and release of those reports. Anyone who subscribes to our email list will get alerted, and those should be out around September. Thank you so much.
Thank you for having me. It's fun. As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.